Hello, thanks for taking time to stop by to watch my report. There's a lot going on in the real estate market, so let's get right into it. First thing we're going to take a look at is inflation. Now, as I'm sure you're aware, there are two things that make up inflation. We've got the so-called headline inflation, composed of all goods and services, and we have the core inflation, which takes out the component of energy and food because those two are very volatile. Core inflation for the month of October was flat. So this brought the annual rate down to 3.2%. Now in September, the annual rate was 3.7%, so that's a nice little reduction. Now this was brought about primarily by a good decline in energy prices. I just filled up with gas at my favorite El Cheapo gas station yesterday and paid $2.59 a gallon. Last week it was $2.64 a gallon. So it keeps coming down. Now, I don't remember exactly how long ago it's been, but around 3-4 months ago, I was paying $3.15 a gallon at the same El Cheapo gas station, so I'm happy to see energy prices coming down. But the core inflation is remaining fairly stubborn, and as I say, it's 4.0%. The Fed is attempting to get that down to 2.0%. Thus, they've had this long run of about 13 months where they've been increasing the Fed rate relentlessly is the only word I can say for it. Now, in the last two Fed meetings, they have paused, so they've kept the Fed's rate at the 5.25 to 5.50% target rate that they have it at now. The good news on the inflation front made the bond market absolutely giddy. It triggered a major rally. As a result, the yield on the 10-year U.S. Treasury bond dropped below 4.5%. So this is great news for mortgage rates and interest rates in general. Also, we have good news on the Producer Price Index, or the PPI as they call it. In October, that actually dropped 0.5%, bringing the annual inflation for the producers to 1.3%, which in my opinion is a good sign of things to come for consumer inflation. Now, on the overall economy, the third quarter saw a gross domestic product increase of 4.9%, which is a good strong rate of growth. And as I've mentioned in previous reports, that's fueled primarily by consumer spending. Now, although consumer spending dropped 0.1% month over month in October, that was due largely to the reduction in fuel prices that I just mentioned. So overall, consumer spending does still remain very strong. Now, in discussing the reduction in fuel cost, we do have to consider the fact that there is a seasonal decline in fuel prices around this time of year because the summer driving season is over, but it seems to be a little more of a decrease this year than would be typical. As I said, the good news on the inflation front has put the bond market into party mode, and they are anticipating that we have seen the last of the rate hikes. And a very authoritative source of information on this is the Chicago Mercantile Exchange. Taking a look at these charts, we'll see that for the December 13th meeting of the Fed, the CME is forecasting a 100% chance that rates will remain unchanged. Also, in the January 31st meeting, they are predicting the same result, 100% chance that the rates will remain unchanged, and that, if it holds true, will be the fourth meeting in a row that the Fed has not increased the rates. Now, for the March 20th meeting, they're still predicting a 72% chance that the rate will remain the same, but they're also predicting a 28% change that it will drop 25 basis points. Probably won't, in my opinion, because of the hawkish comments out of Chairman Powell and Kashkari up in Minneapolis and Bowman on the board and Logan out in Dallas. So there's still a lot of hawks on the Federal Open Markets Committee. You know, with the improving news on inflation, I'm hoping that some of the doves, and there aren't very many of them, Goolsby primarily out of Chicago and Bostic out of Atlanta, and Cook on the board is slightly dovish. But hopefully the doves will have a little more influence in the coming meetings because of the continuing improvement in inflation. Now, when we look on to the May meeting, they're still predicting a 39% chance that they'll be unchanged at that point, but a 47% chance that it'll drop 25 basis points, and even a 12% chance that it will drop 50 basis points. By the time we get out to the July meeting, the CME is practically dismissing the thought that rates will not reduce at least some, with a 38% chance of a 50 basis point reduction and a 20% chance of a 75 basis point reduction. Moving on to the September meeting, the odds of a 50% basis point reduction by that point are looking around 32%, and odds of a 75 basis point reduction are looking at 32%. 31.7, close enough. So as time goes on, if inflation continues to decrease smoothly, then it's looking better and better. Now moving on to the November meeting next year, they're looking at a 32% chance of a 75 basis point reduction and a 23% chance of a 100 basis point reduction and even a 8.8% chance of a 125 basis point reduction. And if everything continues on the same trajectory it's on, by the time they get to the December meeting in 2024, we're looking at a 30% chance of a 100 basis point reduction, a 19% chance of 125, and they're even thinking a 6.5% chance of a 150 basis point reduction. So, according to the brains and the computers at the CME, it's looking good for the future if inflation doesn't fire back up. Now, taking a look at the housing market, buyer demand is falling, and it appears to be more than just the seasonal reduction in demand for this time of year. There's been a big drop in the Northeast, and generally buyers are pessimistic at this time. In the monthly home purchase survey sentiment conducted by Fannie Mae, 87% of buyers said that this was a bad time to buy a home. 78% said the economy is on the wrong track. However, I would note that in June of 2021, 65% of those surveyed said that it was a bad time to buy, and since then, home prices have gone up 20%. Now, I do believe that we are reaching a plateau in home prices, and I expect to see them leveling out for a while, and we may even see a dip in prices similar to what we saw in the third quarter of 2022. However, I'll point out that we've been recovered from that dip for a number of months now. And in the long run, prices are going to continue to go up. The goal is to have them go up at a moderate pace instead of the crazy nutsoid case that it's been doing for the last couple of years. And I'm going to be doing another video on just why that is. But as I say, prices are going to continue to increase in the long run for everything. For example, I remember in 1973, I paid 50 cents for a gallon of milk. Have you priced a gallon of milk lately? The downward pressure on home prices is coming primarily from mortgage rates being near their 23-year high. In fact, they hit the 23-year high on October the 19th of this year. So they have come down some since then, and that's welcome news, but they're still high compared to a lot of existing mortgages that are out there, and we're going to talk about that in just a minute. Now, one area that has been providing some relief for the lack of inventory of existing homes is new home construction. However, builder sentiment is taking a major hit as well. The Housing Market Index, published by the National Association of Home Builders, has dropped to a new recent low. The index reached 34 here in November. It's down from 40 in October. Anything below 50 is bearish. Now, the reason for the gloom and doom in the building industry is mortgage rates for the consumers, because the high mortgage rates is slowing down demand even for new construction. And high interest rates is a double whammy because the builders themselves have to get loans to develop their projects, and they're having to pay higher costs. Now, just as a side note, the BCI back in November of last year was 33, which is virtually the same as it is right now. And as I just said, this survey was taken before the reduction in rates, so we'll see how that affected their mood. Now let's take a quick look at the profile of buyers and sellers for 2023. On the buyer side, the typical home was 1,850 square feet with 3 bedrooms and 2 baths and was built in 1985. Most buyers say they expect to stay in their home for at least 15 years. First-time buyers make up 32% of the purchases, and that's up from 26% last year. However, it's worth noting that long-term, 38% of purchases have typically been from first-time buyers. Now, household income for buyers is currently at $107,000 a year, and that's up from $88,000 last year. And one reason for this is the fact that the buyers are tending to be older at this point, so they're more established and have longer time in their career. The typical buyer right now is 35 years old, and of interest, 19% of the buyers are single females and only 10% of the buyers are single males. Typical down payment for the first-time buyer is 8%, and for repeat buyers it's 18%, and obviously that's because they have built equity in the home that they previously owned. 95% of those buyers between the ages of 18 and 44 got a mortgage for their purchase, while for those that are 65 plus, only 57% got a mortgage. 71% of the buyers only interviewed one agent to do their home search with them, and 90% said that they would use the same agent again. Now, on the seller side, the typical seller is 60 years old, and they're typically getting list price, and 1 out of 3 are getting over list price. And let me put a comment on those numbers right there. I will agree that there are still houses selling for more than list price, and there are still houses selling for list price, but I'm not sure that I would put the word typical on there because prices have leveled, and looking at the Knoxville numbers here, I'm seeing the sale to list price at about 96%, and the sale to original list price is about 94%. So there are a significant number of properties that are being reduced before they sell, and even when they sell, there are a significant number of properties that are going for somewhat less than the asking price. So while it is still, in my opinion, a seller's market, it's becoming less so, and we also see that with the days on market. Nationwide and here in Knoxville, they're going up. It's around 33, 34 days on market nationwide and in Knoxville right now. Now, as we take a look at the MBS Highway Housing Survey of real estate agents, the index has dropped to 31 in November, and that's down from 35 in October. November of 2022, however, was only 13. The buyer activity has slowed as rates have spiked above 8%, although I will point out that they only stayed above 8% for a short period of time, although of course every rate is dependent on the buyer, and so when I'm talking about rates, I'm talking about average rates overall. So those with less than perfect credit scores are going to pay a higher rate, and there are other factors that figure into it too, and I'll have to get Janine Stome on here and have a talk with her about just what all goes into the interest rate. Janine's at Bay Equity. She's one of the mortgage brokers that I deal with quite a bit. Even with the slowdown in buyer demand, prices are remaining pretty stable. They're not going up at the rate they were, but they're not really falling that much either. The low inventory level is the factor that is supporting the higher prices. Let's discuss the reason for the limited inventory of existing homes. Reviewing this chart, which we looked at a few weeks ago, 23.5% of the existing mortgages are less than 3% interest rate. 62% of existing mortgages are less than 4%. 82% are less than 5%, and just under 92% of existing mortgages are less than 6%. So the lower the mortgage that the individual has on their current home, the less willing to sell they are. Thus, we have the inventory problem. And as an overall effect, this entire thing has resulted in a drastic reduction in the number of homes sold. In a typical year, the number of homes sold is usually about 5.5 million. However, it's dropped considerably. In 2022, 5.0 million were sold, but in 2023, we are anticipating about 4.0 million homes sold. It is looking a little brighter for next year. According to the National Association of Realtors, their projection is that 4.8 million homes should be sold next year. Now, they are anticipating a reduction in mortgage interest rates, and I think that will come to pass certainly by mid-year at the latest, and that is going to free up some inventory, and the lower it goes, the more inventory it's going to free up. There are a significant number of sellers that feel locked in by their interest rate, but They have life events happening, and as life goes on, they're going to be feeling more pressure to bite the bullet and sell. But as I've said, the lower interest rates go, the more willing to sell their existing home and get a new mortgage these people are going to be. A lot of them can't wait much longer. So, what happens in 2 years? 7 million new babies are born, 3 million new marriages occur, 1.5 million divorces, 7 million people turn 65 or older. There are 4 million deaths, 4 million net new jobs, and 50 million job switches. So my point is, there is seller demand that's just waiting to hit the market. On the other hand, why do people buy a house? Well, it's to live their life in. These same events are happening for buyers. They're getting married, having babies, switching jobs, getting divorced, and shuffling off this mortal coil just like the sellers. And while active buyers are down due to the interest rates, as soon as the interest rates start coming down, you're going to see buyer demand start increasing dramatically. Another reason that we're not going to have this housing crash that a lot of alarmists are yelling about. Now we get to mortgage rates. The average 30-year fixed-rate mortgage hit a high of 8.03% on October the 19th. Currently it stands at 7.36%. A year ago it was 6.65%. And it had a recent low of 5.99% in February of this year. So now that we've had 2 meetings in which the Federal Open Markets Committee did not raise their target interest rate, we've had some relief in the mortgage rates and a rally in the bond market, so things are looking improved. I wouldn't say great, but they're looking improved. So if the Chicago Mercantile Exchange predictions hold true, I think we're looking for a much better year in 2024. So we might actually have reached the point where the bucking bronco has slowed to a nice slow walk. So that's my report for this week. If you have questions or comments, please put them below. If you have a subject on the real estate world that you'd like to see me cover in a different video, put that in the comments as well. And if you got good information out of this report, please like and subscribe and ring the bell so that you'll get updated whenever I put a new report online. So as Sebastian says, thanks for watching and have a good night.